In exercise 2.4, you're presented with a list of accounts and asked to identify what major classification it belongs to, what's its normal balance, and how it's increased or decreased, meaning is that a debit or credit. If you feel comfortable at the rules of debits and credits, go ahead and jump in. If you don't feel so comfortable, and don't worry, accounting is like a different language and it's tough to get the hang of debits and credits, go ahead and check out some of the beginning of this video where I'm going to go ahead and give you a little bit of a review. So I'm going to start out with our accounting equation. In accounting, whether a debit means increase or decrease, or a credit means increase or decrease, really depends upon the particular type of an account we're talking about. For example, is it an asset? Is it a liability? Is it equity? This is often just a little confusing, probably not a little confusing, probably a lot confusing to many at first, because in the banking industry, debit actually means to decrease and credit firmly means to increase. You may have noticed this on a bank statement or an ATM receipt. Keep in mind, however, that for a bank, they're only looking at the rules of debit and credit according to one type of account, not lots of different types of accounts. They're just looking at your money in the bank. That's their perspective. In accounting, however, debit just means left-hand side of the account and credit means right-hand side of the T account. Whether or not it's an increase or decrease to a particular account depends upon the account that we're talking about. The good news is that the accounting equation that we've already learned from a prior chapter can help us out with these particular rules. Because assets are on the left-hand side of the accounting equation, to increase any asset, we're going to debit the T account, which is its left-hand side over here. Remember, left side's the debit, right side's the credit. So since assets are on the left, we're going to debit it on the left-hand side. On the other hand, because liabilities are on the right-hand side of the accounting equation, to increase any liability, we would credit it, which is its right-hand side. We're going to follow much the same rules for equity. It falls on the right-hand side. To increase equity, we would credit it. So therefore, we look at what side of the accounting equation the account falls within, and that's the side of the account we use to increase it. If we can remember the rules have how to increase an account, we can also do the opposite to decrease it. So for example, we know how to increase an asset because it's on the left-hand side of the accounting equation. So to increase any asset, we're just going to put the dollar amount on the left-hand side of the T account, the debit side. However, if we wanted to decrease an asset account, we would do the opposite. We would credit it. We would affect its right-hand side. On the other hand, to decrease liabilities and equity, we would debit them. I've listed below some of the typical examples of assets, liabilities, and equity. Keep in mind it's not an exhaustive list, but this is a fairly typical list. So for example, if I know that cash, for an example, is an asset, well, we would debit the cash account in order to increase it. If I know, on the other hand, that notes payable is a liability, it follows the normal right-hand rules that we would credit the notes payable account in order to increase it. So sounds simple, right? The problem is that the rules above do get, although they work for the classic examples of assets, liabilities, and equity, they get a little bit more complex when we apply them to the different elements of retained earnings. What I mean by that is our revenues, expenses, and dividends. So let's go ahead and tackle that next. Recall that we had just mentioned that equity accounts have a normal credit balance since they reside on the right-hand side of the accounting equation. That's going to be correct for retained earnings and also the other classic example of equity, which is going to include common stock or any other contributed capital accounts. And that seems like a scary term, but I just mean things like preferred stock or additional paid-in capital. Those are extra equity accounts we'll talk about in a later chapter. There are, however, some additional accounts that we still need to talk about. And I like to use the acronym RED, R-E-D, for those accounts. The R stands for revenues, the E stands for expenses, and the D stands for dividends. While these accounts are not actual equity accounts, they indirectly affect equity, and we can use that impact or indirect effect to understand the rules for debits and credits. Before I get going on that, let's just make sure we review two statements to understand the impact on equity, the income statement and the statement of retained earnings. So let's first review real quick that net income on our income statement is going to include the addition of revenues minus expenses or the cost of doing business on our income statement. Then our next statement was our statement of retained earnings. How we get ending retained earnings on our statement of retained earnings is we first take our beginning retained earnings, the beginning year, we add in our net income, so therefore we're actually adding in revenues, but then taking out any cost or expenses of our business. Next, we will subtract out any dividends or distributions to our stockholders, and that gives us our overall ending retained earnings. So if we think about that, if we're talking about revenues first, revenues ultimately increase income up here, ultimately increase income. That income in turn increases retained earnings. And since retained earnings is a form of equity, ultimately equity increases in the business. Because of this, revenue has a normal credit balance just like common stock or any other equity account. And when I say normal credit balance, the normal balance is just whatever side of the accounts it's going to be increased by. It just means if we're increasing revenues, we're going to credit it or affect its right-hand side. Normal balance also means that that's when we look at the account balance, we expect that it's going to exist on that side. For revenues, it's going to exist on that credit side. Expenses and dividends, however, are going to be a little bit more tricky. Expenses ultimately reduce the income or net income or profit of a business. This in turn decreases retained earnings and ultimately then in turn reduces the equity of the business. Because of this, expenses have opposite the normal balance of an equity account. Instead of being increased with a credit, have opposite the rules, they're going to be increased by debit, meaning they have a normal debit balance. Similar for dividends. Dividends reduce the earnings retained in a business, which ultimately reduces its equity. Since similar to expenses, we're reducing the equity. It has opposite the normal right-hand rules in that it's going to be increased by debit, or we can also say it has a normal debit balance. So just to summarize real quick, revenues and stock issuances increase equity. So these accounts, revenues or common stock, are going to follow the normal right-hand side of the equation rules and have a normal credit balance, meaning they're going to be increased with a credit. Since expenses and dividends reduce the equity in a business, they instead are going to be increased with a debit, meaning they have a normal debit balance. So we've reviewed our exceptions. There's also an acronym that may help you remember all these rules for the different accounts. And it's what we have listed here to our left, ADELOR. So question might be, what does this stand for? The ADE stands for A stands for assets, D stands for dividends, and E stands for expenses. They all follow the same rules of debits and credits. They're all increased by debits, or we can say they all have a normal debit balance, and that's why I've got them here on the left-hand side. On the other hand, on our right-hand side over here, I have LOR. L stands for liabilities. Oh, it's a little bit tricky. It's going to stand for owner's equity. You might say, why didn't I include E for equity? Well, I already had an E for an expense, so I didn't want to confuse you. So it stands for owner's equity, and also the R stands for revenues. These are here on the right-hand side, which means they're going to follow the normal right-hand rules of having a normal credit balance or being increased with a credit. So hopefully, for those that reviewed this part, it helps you out a little bit with the rules of debit and credit. We're going to go ahead and jump into our problem next, and it's asking us to identify what type of an account, whether this particular account is an asset, liability, equity, revenue, or expense, what its normal balance is, meaning is it a debit or credit, and whether a debit or credit is going to increase this particular account. Our first account is going to be prepaid rent. When you see the term prepaid, think asset. So for example, this might be a situation that we paid our landlord 12 months in advance. So we've got a future benefit. We've got a facility that we're going to utilize in the future. We haven't used it all up. That's going to be an asset. Assets follow the normal left-hand rules and that the normal balance is going to be a debit because of the fact it's going to be an increase with a debit or its left-hand side. If I went a step further, although the problem doesn't ask, just a quick review of what particular financial statement would this account reside on? Assets show up on the balance sheet. The next account is going to be supplies. Supplies is another example of an asset. So similar to prepaid rent, normal left-hand rules that the normal balance is going to be a debit and it's going to be increased on its left-hand side or the debit side. Our next account is going to be a little bit different, fuel expense. Now, it pretty much gives it away that it has the word expense within the term. The good thing about expenses is they usually have the word expense somewhere in it, like office expense, salaries expense, whatever it might be. So this is going to be an expense. We'll get to some later chapters where we'll throw a bit of a wrinkle like cost of goods sold, but for now, most of them have the word expense in it. Now, you might say it's indirectly a form of equity, but keep in mind expenses actually reduce equity in the business, so they're going to follow opposite the normal right-hand rules. They're going to have a normal debit balance and be increased by a debit versus a credit. Now, again, if I periodically ask the question, which financial statement does this appear on? Expenses appear on the income statement as a reduction of our revenues. Speaking of revenues, it's going to be our next account, consulting revenues. This one's nice. It actually has the term revenue in it. Some aren't labeled quite as well depending upon the type of product or service a company offers. For example, a lawyer might have, for example, fees earned. A little bit more tricky. The type of an account, though, is going to be revenue. It follows the normal right-hand rules because it ultimately increases equity. So the normal balance is going to be a credit, and the increase is also going to be with a credit on our right-hand side. Similar to fuel expense, consulting revenue would appear on our income statement. Unearned subscription revenue. Well, you might say, well, the one before had the word revenue in it, and this was revenue. The problem is when we add the term unearned to this particular what looks like a revenue account, we turn it from revenue to a liability. Unearned means that this is a liability, this is an obligation. For example, this might be something like Wall Street Journal, where you get customers that pay in for a 6-month, 6-week, 1-year, whatever subscription it is. Whenever that money's paid in, they can't record it as revenue because they haven't done anything yet. They've got an outstanding obligation to provide future papers, future magazines, whatever it is. Until the point they do, it's going to appear as a liability. Liabilities follow the normal right-hand rules of a normal credit balance and being increased with a credit. Since it's a liability, similar to our assets, it would appear on the balance sheet. Common stock is going to be a core equity account. It represents owners' investments within the company. It's going to follow the normal right-hand rules of a normal balance of a credit and being increased with a credit. It also, like the assets and liabilities, is going to appear on the balance sheet. Accounts receivable. Whenever you see the term receivable, think asset. This is an expectation of some type of benefit that's going to be provided to us in the future. In fact, accounts receivable is an IOU from a customer. Typically, it's the amount of cash we expect to be paid from our customers. But again, anytime you see the word receivable, think asset. Assets follow the normal left-hand rules and that they're going to have a normal debit balance and be increased on the left-hand side or the debit side. Utilities payable. It can be a little bit confusing. Receivable, payable, a lot of times those get turned around at the beginning. Which one's an asset, which one's a liability? Receivable is something you're expected, either cash, product, service, to be paid or presented to you, a future benefit. On the other hand, payable is an obligation you have to someone else, whether that's an obligation to pay cash, provide a product, provide a service, but it's an obligation nonetheless. So utilities payable is going to be a liability. It's going to follow the normal right-hand rules of the normal balance is going to be credit, and it's going to be increased with a credit. Similar to our other liability of unearned subscription revenue, utilities payable is going to appear on our balance sheet.